Chapter 6 of the book starts off with the author feeling testy after reading an article featuring an interview with a famous economist. The economist argues that the theory of efficient markets is changing due to new trading technologies, making the market more volatile and rendering the buy and hold strategy ineffective. However, the author disagrees with this conclusion and believes that investors should toughen up and cure their bad behavior instead. The author criticizes the economist's recommendation of holding a variety of mutual funds and suggests that investors should recognize and correct their counterproductive psychology that leads to bad investing. The author then goes on to discuss the inevitability of market crashes and the importance of staying the course during these times. They emphasize that the market always recovers and that it is the best performing investment class over time. The author also highlights the fact that the market always goes up, although not in a smooth manner, and that there will always be collapses, recessions, and disasters in the future. They stress the need for investors to toughen up, ignore the noise, and ride out the storm. The author concludes the chapter by stating that there will be more market crashes in the future, but they should be seen as buying opportunities rather than the end of the world. In the upcoming chapters, the author promises to discuss why the market always goes up and provide guidance on how to invest at each stage of life to become rich and stay that way. They emphasize that the process is simple but requires investors to be tough. In this chapter, the author shares a personal story about the stock market crash of 1987, also known as Black Monday. He recounts how he initially held firm and didn't panic, but eventually lost his nerve and sold his stocks. However, he learned from this experience and became tougher and more resilient in the face of future market storms. The author emphasizes that despite the volatility and occasional crashes, the market always goes up in the long run. He presents a chart of the Dow Jones Industrial Average from 1900 to 2012, highlighting the market's upward trajectory over time. The author explains that the market always goes up because it is self-cleansing, with companies fading away and being replaced by new ones. Additionally, owning stock means owning a part of dynamic companies that are constantly striving to succeed. The author concludes by acknowledging that while the market's upward climb is a great wealth-building tool, it can also be a wild and unsettling ride with occasional big, ugly events. In this chapter, the author discusses why most people lose money in the stock market. He explains that one of the main reasons is because people believe they can time the market, buying high and selling low. This behavior is a result of our psychological makeup and is difficult to change. The author also explains that picking individual stocks is another common mistake, as even professionals struggle to consistently pick winners. Additionally, many people believe they can pick winning mutual fund managers, but the reality is that most funds fail to outperform the index. Lastly, the author emphasizes the importance of focusing on the actual businesses in the stock market, rather than getting caught up in the daily fluctuations and noise of the market. Overall, the chapter highlights the common pitfalls that led to financial losses in the stock market and encourages readers to adopt a long-term, diversified investment strategy.